SoFi reported their Q4 earnings before the bell, and on today's show, we're going to go through them. We'll take a look at all the revenues, the profits, the expenses, everything that you need to know when it comes to SoFi. We'll come over here and look at this from a technical perspective. Now, after reporting their Q4 earnings this morning, the stock's up over 14%, but it is still down over 40% over the last year. But year to date, like a lot of speculative stocks, this thing is ripping up over 50%. We'll talk about this from a technical perspective. This one's actually setting up kind of nicely. And given the volume and the attention that this stock has, they also have options. I tell you what, it sometimes makes a nice combination. You got a low dollar stock, but with a lot of interest and a lot of volume. That's how I've played SoFi in the past. We'll talk about that more when we get to the technical segment of the show. But again, over the last year, down 40%, but some signs of life for SoFi as they grew their revenues year over year on a quarterly basis by over 58%. That beat expectations by about $17 million at nearly $444 million worth of revenue. Now, I think the more important thing, though, is the company gave really strong guidance for the upcoming quarters. For the Q1, which is the quarter we're currently in, $430 to $440 million worth of revenue. Consensus estimates was for $425. Now, $425 is still 52% growth year over year. So what this has you believing at SoFi is they're going to be able to meet these strong revenue estimates that Wall Street has for this company. We're talking about 40, 30, 20%. Now, it's obviously going to start to tail off at some point, but I tell you what, out basically into infinity, 20 to 30% growth rate on the top line over at this bank. Now, for the full year, they gave you the full year guidance. They're expecting that to come in between $1.925 billion up to nearly $2 billion. The consensus was for $153. I actually think that is a typo. What they are talking about is the consensus was actually for $1.98 billion. So essentially, SoFi kind of straddling Wall Street expectations. And look, that is still up nearly 30% if they hit close to that $2 billion mark on those full year earnings. Very strong revenue, very strong guidance from the company, but as often is the case with this company, it will come more or less down to profits. We'll go through those here in a second. Now, student loan defaults could cross pre-COVID levels without debt relief. Obviously, Joe Biden's attempt to relieve some student loan borrowers is hitting some roadblocks when it comes to court challenges. We'll see how that shakes out. But what it could do is it could raise the default rate really across the board when it comes to student loan debt, as you had a portion of borrowers that were expecting some kind of federal relief, and then maybe other borrowers out there, deciding just to kick the can down the road and not pay their loans. We'll talk about that when we get to loan mix over at SoFi. Very interesting. Now, SoFi Technologies ran earlier in December as the CEO bought over 5 million shares of common stocks. You think he saw some of the preliminary results for his earnings and he stepped in there. Typically when a CEO does this, you notice he stepped in here and bought these somewhere in the $4 range. Anytime a CEO steps in and buys stocks before earnings, typically it gives you a pretty good clue that they're going to come in pretty nicely. Now, lending originations over at SoFi for the last 3 months, what we've seen is a shift. And so look, to the company's credit, they're able to shift around their loan mix based on demand. In the past, student loan, home loans have been actually a predominant and a much larger business for the company. Obviously, as we've seen over the last year, home loans starting to take a little bit of a dump. Student loans, people willingness to take out loans, especially kind of a third-party loan. If the government has shown kind of a propensity or a willingness to pay off the loans, well, I'd probably rather just borrow money from the government. On top of that, we're seeing the amount of people taking out student loan debt. That is starting to decline a little bit. In fact, people attending college has actually started to decline a little bit. We'll see if that's just a shorter-term trend or something that will continue. So we've shifted really into personal loans over at SoFi. And so that's great that they're able to shift that around, but obviously a personal loan is not secured. We see up 50% year over year on those personal loans. Those aren't secured. secured. They tend to carry higher interest rates, but obviously higher default rates as well. We'll see how SoFi is offsetting that with their loan reserves here in a moment. We'll get to the balance sheet. But student loans down 72% year over year, and home loans down 84%. I tell you what, this company is well positioned if they can get the student loan business and the home loan business to have obviously they're coming up against low comps this time next year. They'll probably have growth in this industry, but boy, if they can reaccelerate student loans back to $1 billion business like it was a year ago, well, certainly the company is probably going to be doing relatively well from a financial perspective. Now, speaking of the financial perspective, come over here to the statement of operations. This company's obviously shifted their balance in a year or two ago. They didn't even take deposits over this company. They just started their bank charter. I think it was earlier this year or late last year. And so they started taking deposits, and obviously having a bank charter where you're taking on deposit, you're then loaning out that money, and it is incredibly high margins. You see their loans here on the interest income side just up dramatically year over year. I mean, we're talking up over $200 million. Total interest income just up again threefold from $94 million all the way up to $307. Your interest expense just beautiful. This is why they got that bank charter. You see just $98 million worth of expenses that off of $307 in interest income. You have just $98 million in expenses that gave you net interest income of $208 million, up like just tremendously over a year ago, where you were just at $76 million. You see for the full year, you went from $252, more than a double, up to $584. So if they can just keep moving this in the right direction, that is incredibly good for this company. Now, they have other non-interest income as well. They're still originating loans, selling those off. They have other types of fees and technology. Total non-interest income coming in at $248. And so I talked about how there's this complete shift in the business. Last year, net interest income was $76 million, and your non-interest income was $209 million. So a big shift to that. And now this year, I would assume over the next year, the net interest income is actually going to be the largest portion of this bank's business, as they'll still have this non-interest income, but it'll be a smaller percentage. And from a cost perspective, a margin, a profit perspective, that is exactly what you want to see actually over at SoFi. So you had your total net revenues here coming in at that $456 million. What they show you here on a press release is essentially an adjusted number. This is why I always pull up the numbers. You get them all and you can adjust them yourself if you feel like it. But we got $456 million. Now we've got our expenses over at SoFi, and the expenses still exceed the revenues, but boy, it's getting close. This company's at the tipping point, I believe, of profitability. Now, across the board, we are seeing our expenses go up, but they are not outpacing the revenues. Last year, total expenses were at $395. They were up about $100 million to $495. So you take $456, you minus off $495, and you get a net loss of just $40 million. A dramatic increase over last year, where you lost $111 million, and a dramatic increase over the previous quarter, since you lost about $320 million over the last year. Tell you what, if you're on this $40 million or less run rate, it's a company very well positioned to enter this year, coming very close to kind of a net profit from an operating perspective. Now, provisions for credit losses. Anytime you're passing out these personal loans, even student loans and home loans to a lesser degree, you've got to set money aside for these credit losses, and that changes the bank up a little bit if we go into a recession or if people start losing their jobs. Obviously, there's going to be a higher percentage of these people that don't pay back these $2.5 billion worth of personal loans. And so you see over the last year, you went from 4.7 up to nearly $15 million on those provisions for credit losses. Again, some of that or a lot of that has to do with just the shift in business where they're taking on these loans. They're carrying these loans on their balance sheet, but obviously a story to monitor year over year, just up dramatically. We'll see how this company is able to wade through this. The other thing that you need to keep in mind with SoFi is heavy dilution over at this company. Weighted outstanding shares last year was 526, nearly doubled to 900. So dramatic. I mean, we're talking about dramatic dilution. That is one of the reasons why I have not kind of bought and hold this stock. It's more of a trading vehicle, only because they continue to dilute shareholders rather rapidly. Now, from a balance sheet perspective, looks really good. They've got plenty of cash based on their financials and their operating and their guidance that they gave you for the quarter. This company is not in any real big risk unless there's a big recession and people lose massive amount of jobs. jobs that would really impact this stock, but they have plenty of cash. If you definitely have kind of a softish landing, well, this company's relatively well positioned from a liability perspective. They do have some debt, but that is typical with these types of banks. Now, from a cash flow perspective, difficult to analyze the company. I wouldn't analyze the company that they had over $7 billion worth of negative cash flow over the last year on an operating loss of about $320 million. That is because the way the accounting works for a bank doesn't really work out for cash flow, so I wouldn't really worry about that. But again, you have very large amounts of stock-based compensation over this company, over $305 million. Again, that matched basically the net loss that the company had. They invested a lot in property, plant, and equipment and software over the last year. We'll see if that kind of normalizes into 2023. And then from an investing perspective, they issued some debt, they paid down some debt. Here's your net change in deposits. So it shows you the big shift that this company had over the last year. Last year, they had no deposits. They didn't even have the bank charter. That came through this year, over $7.1 billion worth of deposits. We'll see if they're able to attract more of those and how good they are at lending these types of things out. And then obviously, if interest rates stay relatively high, quote unquote high, for a period of time, that certainly will benefit this company over the longer run. Now, come over here and look at this from a technical perspective. Hello, I love this. Yeah, if you've held this one for any period of time, you've gotten just absolutely blasted. So I wouldn't necessarily hold a stock like this, but we have finally kind of broken out of this trend. Now, some of you might say, well, we were in this kind of upper trend line, we're kind of sideways trend, and then we broke down below and kind of peaked our head, and then it was kind of a fake out. Well, now we're on this big uptrend, okay? So the momentum is certainly in this one. It's looking relatively good. I think the way I would play this one is, I tell you what, you've got a lot of space here. You get to the top of the range, that's another 40% move on this one. Even if you get just back to the middle of the range, that's still an 18-19% run on this stock. You would not, I repeat, you would not want it to break below probably those lows or this gap here. Even you really wouldn't want even this gap being filled. If I bought this stock today at $6.85, I'd have a stop loss at the very least at about $6 per share. I'd be looking for it to run about 18-19% with about 10% downside. So not quite the 3-to-1 risk reward that you're looking for. But I tell you what, you get towards the top of the range, that's when you get to kind of a 3, 4, 5-to-1 risk reward in this one. This is more of an options trade with me. The options are pretty cheap given the value of the stock, and they're liquid enough. From a buy and hold perspective, I'm still not convinced this company's business is going to be consistent enough to really generate longer term returns for investors. You have that massive share dilution as well. The company is still trying to scale up, but from a price swing perspective and trading on technicals, this one actually looks relatively decent to the upside in the shorter term. Your risk, though, is that risk on trade disintegrates after the month of January, where you tend to have strong results as people have deposited into their 401ks, IRAs, and those types of things. Hopefully you guys enjoyed today's video. Obviously a huge earnings week this week with Apple, Google, and Meta. We'll be here to cover it here on the channel. Hopefully you guys have a wonderful day out there, and good luck with your investments.